Today I'm back again with Craig Johnson, our Chief Asset Officer here at PPR Capital Management, to talk about the latest updates in our multifamily portfolio. Nationally, the multifamily environment has stayed surprisingly strong even with broader economic headwinds. National occupancy is holding above 95%, and rent growth has cooled down even though it remains strong in certain areas like the Northeast and Midwest. Craig is here to talk about what regional trends are driving our portfolio today and how tightening supply may impact the outlook for multifamily going forward. Craig, as you look at the national multifamily landscape, multifamily remains resilient. Given the economic uncertainty that we've seen this year, what's your read on the overall health for multifamily, and how are we positioning our portfolio to continue to grow?
Yeah, no, that's a great question, and I think honestly, I would say I'm pretty excited for the multifamily market going forward. I think it's kind of been obviously a pretty bumpy ride for the industry as a whole, starting in 2020 when the pandemic hit, and then through 2022, the amazing rent growth, incredible performance nationally, and then following that, kind of the supply wave, the unexpected weakness in rent, still strong demand, but just so much supply coming on board. So, I think that it has demonstrated that truly, when you look at the fundamentals of the marketplace, there still is a housing shortage in the United States. That's not going anywhere. That affordability gap between renting and owning, if you look at the median data nationwide, there's still about an $800 a month gap between the mortgage on the average house and the rent at an average apartment. So, I would say you've now seen 6 consecutive quarters, the NICREIF index showing, from a capital markets perspective, value increases on multifamily. So trending back towards the peak that occurred back in Q3 of 2022. So overall, I'd say, like you mentioned, depends on the market, depends on the region, all that. But I would say that the markets for multifamily nationwide is in a good position going forward, and I think the industry is pretty bullish on the next 3 to 5 years.
Mm-hmm. And we kind of alluded to this a little bit, but it sounds like across the regions, it's kind of a split story. You have markets like the Sun Belt, which are seeing kind of a decrease in values and dropping in rents, while you have areas like the Midwest and the Northeast that are continuing to kind of chug along. What's the story behind this divergence, and how are we positioning PPR to kind of take advantage of this, of the dynamic here?
Yeah, I think it's something that has always surprises me about commercial real estate, is how still kind of analog, or frankly unsophisticated a lot of people and operators can tend to be, because this was not that difficult to see coming, right? When you look at the supply as far as the number of starts, the properties under construction that occurred in the Sun Belt, whether that's your Miami or other Florida markets, a lot of the Texas markets like San Antonio or Dallas or Phoenix, Arizona, any of them, and you looked at just how many units were being built, and it made sense as to why, when you saw people flocking to those areas post-pandemic, lots of household formation, tons of demand, rent growth of 15% year over year, just incredible numbers. I think a lot of people just saw dollar signs and kind of went to build, but pretty quickly you could see that this was going to happen. And so that there's all the supply would enter the market, and the Sun Belt and kind of the west part of the country as well would eventually underperform. It would eventually catch up, and there would not be, demand still underlying, still strong, like I just mentioned, but just not enough to absorb all the units that were being delivered. And meanwhile, kind of looked at the Midwest and Northeast, not nearly as high of rent growth back in 2021, 2022, not as exciting for kind of new funds or new investors to get into. So you just didn't see all this investment and all this construction. And they, therefore, are kind of just reflecting this underlying dynamic. They are chugging along, to your point, at 4 or 5% annualized rent growth, performing much stronger. And, looking back, that's why I'm excited that as we acquired multi-properties, into Reliant Income Fund, starting, I'd say our current wave started about Q4 of 2023 to Q1 of 2024. If you look at where we acquired, sure, the very top of the Sun Belt, a Knoxville property and one in Nashville, but by and large, 2 properties in Cleveland, 2 properties in Kansas City, and 1 property in Milwaukee, all in that Midwest area. And it's because, we noted that, the Sun Belt, great demographic trends long-term, great net migration long-term, but, if you're looking at that 2, 3, 5-year time horizon based on our investors' needs, it just wasn't the right time to be buying or building in those areas in kind of the recent past. So, I think it has been a tale of different regions, and I'm excited that here at PPR we kind of saw that ahead of time and didn't fall into quite some of the traps that our competitors may have.
Yeah, and it speaks to kind of PPR's kind of lock on data, how we really focus on the data and make decisions based upon that. You know, we didn't follow the herd when the Sun Belt was rising in value. We kind of said, hey, let's check out the Midwest because we see some opportunity here. Year over year, new deliveries are 20 down by 27%, and we're seeing this at almost a decade low in terms of new deliveries. Do you see this as a turning point for multifamily fundamentals? And how could this tightening pipeline impact rent growth and occupancy in the years ahead?
Yeah, I think it is definitely an inflection point for the industry. It kind of reflects, I'd say, the same overcorrection in a negative direction that we had in a positive direction during the pandemic. So, we went from a period where we saw, decade or all-time highs in terms of unit starts, permits being issued, and then, recently new deliveries, and now we're down to decade lows, and I think the big number to watch there is, deliveries are just over 100,000 units nationwide there in Q3, which is kind of in line with Q2. Obviously, to your point, down significantly year over year still, but looking at those unit starts and the new permits being issued, those are just collapsing, right? And we are at decades, record lows there, and I think that's going to continue going forward for at least the next year here. It's anticipated, and that's a real opportunity because, yep, there were markets that were certainly oversupplied, but like I've been mentioning, the Sun Belt, there was just too many units being delivered. There's nothing wrong fundamentally in terms of demographics or demand in those markets. So I think that, a lot of people, including us here at PPR, would say that if you're looking 3-4 years out now, just like 3-4 years ago, you were seeing lots of supply being started, and that's ended up with oversupply in some markets. Now you have almost no supply being built in a lot of markets, and so 3-4 years from now, you'll probably see accelerated rent growth, very good occupancy levels, because the market's overcorrected just a little bit and has created some opportunities there. So I definitely think that this has been a moment that we've been kind of waiting for. We've been seeing that strong absorption, continuing to soak up the supply, but we've been watching that pipeline shrink and shrink and shrink, and it's finally coming to fruition in terms of numbers of units delivered. And I think we're well positioned for that, both in the properties we've already acquired and the ones that we'll continue to acquire going forward.
And it speaks to kind of the efficiency of markets, really. I mean, in PPR, it seems like we're positioning ourselves to take advantage of this dip that we see coming in future availability. So it looks like this quarter in our BTR development, we finished phase one, which is super exciting. And we're on our way to phase two. What did we learn from building out phase one, and what adjustments have we made maybe going into phase two?
Yeah, so that's at our Highline Knoxville property, which we acquired towards the beginning of this year. And it's honestly been, fantastic to watch the business plan kind of, come to fruition there and work out the way that we initially thought. Because, going back to what build to rent is and why we think it's an attractive sector going forward, is that demand from, it's not just the typical lack of housing, gap between affordability of a home and affordability of an apartment, which I already mentioned. It's specifically targeting, either the older folk, maybe divorcees that need to downsize from their home, but do want to age in place in some kind of independent, home-like, not a facility, but an actual house. And that millennial cohort that's kind of the opposite, right? Looking to grow their lives, they've gotten married, they want to get a dog, they need to start having kids, but with that affordability gap, in terms of affording a home, just not there for them in a lot of markets, but they do want to grow. They need to move out of that apartment and into something that they can call home and really feel like they can raise a family in and kind of their own little piece of land. So I think if that were true, kind of that value proposition of build to rent, you would expect to see a lot of retention because you'd expect to see, it's not like an apartment where, on average you see 40 to 50% turnover of your leasing tenants on an annual basis. I'd say if you're at 60% retention in an apartment building, that's normally good. You're happy with your property management. You think you're doing well there. But that's because it's just an apartment, right? It's just somewhere where someone is staying, not necessarily their home. And so far in phase one at Highline Knoxville, we're over 80% retention, which is exactly what you'd expect to see if build to rent was providing this kind of quasi-home, quasi-ownership benefit to the tenants, because you're much less likely to move if you feel like you're living in your home, right? That it's long-term, that you're not just here for a minute until I can go buy a house somewhere else or some temporary. It's really like, oh, I live here now. That's kind of the approach we're looking for. And the only change, I'd say, to your point for phase two that we're breaking ground on right now is actually building a little bit more 4-bedroom units. I think, in phase one, not that we were hedging, but I think, a 3-bedroom build to rent kind of detached but property, maybe it's 1,500, 1,600 square feet. Yes, that's larger than a typical apartment, and yes, we're going to charge a rental premium, but it does still compete with a traditional three-bedroom apartment, right? A three-bedroom apartment can go up to 11, 1,200 square feet. So, you know, even if this build-to-rent thing didn't catch on like we thought, you would still get some spillover from traditional apartment demand, people looking for three bedrooms. And what we found, actually is there's been great demand for three bedrooms that, we are leasing up, we are stabilized, we're about 94% leased at the property, but the four-bedroom units went flying off the shelves. We could not maintain any supply of those. Tons of demand, and again, it just speaks to how many people want a true home. And so in phase two, we're working to rebalance that property. We were originally aiming for about 80% three beds to 20% four beds, and based on the lead traffic and kind of the demand down there locally, we're rebalancing that to about 60-40, three bed versus four bed. So exciting. That actually it's accretive to the IRR on the property, but excited to see that the business plan for BTR kind of bearing fruit down there, and property is being very successful.
And BTR is interesting because it sounds like this is a place where people are planting roots. This isn't just a temporary place for them. And the four-bedroom component there means they can grow into the space for a little bit longer, which means there'll be longer tenants and just stickier tenants there. So this past quarter, we did a lot on the surveillance and technology side too. We did 9 site visits, and we rolled out 2 new kind of surveillance tools. One that allows us to get real-time data from the sites. The other one that allows us to use movement data when analyzing or doing due diligence on properties. Can you talk a little bit about how these tools have given you a lift to your day-to-day operations and how it sets us up for scale in 2026?
Yeah, I'd say it's the culmination, I think, of an initiative, having been in this seat now for about a year. I think that was the two-pronged approach I was looking to bring in as far as asset surveillance is, on the one hand, more people, more boots on the ground, more oversight by us of the properties. And you mentioned that in terms of 9 site visits. We have policies in place now. We're bringing on more asset managers to make sure that we are physically on the properties, every property at least once a year. But depending on level of construction and how much oversight we need and the property's performance, could be up to once a quarter, if not more, that we're going to be physically there, asking questions, talking to tenants ourselves, just making sure we do everything we can, so I can look at an investor and say, we really are doing what we need to do to make sure that this, if at all possible, follows its business plan or exceeds it. So that's kind of the analog prong. But then as far as the digital stuff that you mentioned, yeah, it's very, very helpful to have Symmetry, which is our asset management platform that we built out. That's been kind of the culmination of almost a year-long search and implementation process. Looking to strike the balance between, we don't run the properties and we don't have the staff to make day-to-day decisions. Obviously, that's what we have property management for, that is on site and runs the properties on our behalf. But to have that kind of granular detail in terms of how many tours were there today, how many applications, how many got rejected, what were their credit scores, or how many work orders are open, how long are they taking, right? Were there any evictions? Are there delinquencies? Just any piece of granular data. We don't need to go to our JV partner, who then goes to the property manager to get the answer, and then it kind of comes back. It's a direct link to the property management software that's running on the properties. And so really unfiltered, great transparency, and make sure that we're kind of on top of what's happening at all of our properties. And then that last piece you mentioned is, as far as AI location data, that's been really helpful, yes, on an underwriting perspective of just demographic trends, how many people drive by this site, how many people live in the area, because especially for a build-to-rent property, one of the best ways to identify a good property is to find kind of the next suburb out. A lot of cities that are experiencing growth, it doesn't happen just continuously. It's not linear. It's, the next suburb builds up and builds up and builds up until it reaches a critical mass. And then once it becomes not affordable enough and, young families can't live there, it kind of jumps to the next suburb out, if you think of each city as kind of a ring. And so AI data can help us analyze that and see, hey, are we buying low here? Is this an area that, is right at the precipice of developing and having a lot of demand come in, lots of movement. But it also helps on the surveillance side. I mean, we've made marketing suggestions. You can look at comparable properties and see, of their tenant base, where do they work, right? Where do they shop? Where do they vacation? Anything you want to know. In the aggregate about the people who live at those properties. And so when we then compare to our property, it might be as simple as, hey, if you pull our 5 closest competitors, 10% of their tenants work at this office park that's 15 minutes away. You look at our property, we don't have anyone who works there. Well, why not, right? That sounds like a marketing opportunity. It sounds like we should be giving gift baskets to those employers. We should be reaching out, making contact, or figuring out, what are we doing wrong? Like, why aren't we appealing to the demographic that might work in that location? So just, by bringing more technology to bear, to help us have more transparency and insight into the properties before we buy them and after we buy them, but then also, like I mentioned, diverting a little more resources into asset management and the human touch and the boots on the ground to make sure we get that aspect covered as well.
And it sounds like a lot of it's just about being proactive and getting ahead of issues before they, bubble up to, larger problems. Even just going to the property at least once a quarter, you're able to catch something before, it becomes something that you see on a P&L at the end of the year.
Absolutely.
So yeah, thank you for the update, Craig. I think our investors will appreciate this. If you want to learn more about PPR and our Reliant Income Fund, feel free to visit PPR Capital MGMT /schedule.